Ever wondered how you can invest in the stock market without picking individual stocks? What if you could own a little bit of everything with minimal effort? That's exactly what index funds and ETFs let you do. But what's the difference, and which one is right for you? Stick around, because we're breaking it all down in a way that's easy to understand. What are index funds? Index funds track the performance of a specific market index, such as the S&P 500 for large US stocks, or the Bloomberg US Aggregate Bond Index for US bonds. The appeal of index funds lies in their simplicity and cost-effectiveness. Will Thomas, a certified financial planner at the Liberty Group in Washington, D.C., says, because there's no original strategy, not much active management is required, and so index funds have a lower cost structure than typical mutual funds. By mirroring an index rather than trying to outperform it, these funds have expenses far lower. As of year-end 2023, index mutual funds and ETFs accounted for 48% of assets in long-term funds, up significantly from 19% at year-end 2010. Index mutual funds are priced once daily after the market closes, and investors buy or sell shares directly from the fund company. Thomas noted, although they also hold a basket of assets, ETFs are more akin to equities than to mutual funds. Listed on market exchanges just like individual stocks, they are highly liquid. They can be bought and sold like stock shares throughout the trading day, with prices fluctuating constantly. Index mutual funds have revolutionized investing since their introduction in the 1970s, offering a low-cost way for investors to gain broad market exposure. These funds aim to replicate the performance of a specific market index, such as the S&P 500 for large US stocks, or the Bloomberg US Aggregate Bond Index for bonds. Here are some of their key features. Broad diversification. Index funds offer exposure to hundreds or thousands of securities in one product. Low expenses. With minimal research and trading, index funds have lower fees, 0.06% versus 0.66% for active funds in 2023. Passive management. They track an index rather than trying to outperform it. Predictability. Returns closely follow the benchmark, reducing volatility. Tax efficiency. Lower turnover means fewer taxable events for investors. The popularity of index mutual funds has grown significantly over the past decade. As of year-end 2023, index mutual funds held $5.9 trillion in total net assets, representing 30% of long-term mutual fund assets. However, index funds are not without risks. They will fall in value when their target index declines, and they may underperform actively managed funds during certain market conditions. In addition, not all indexes are created equal, and some may be more representative of their target market than others. Exchange-traded funds, ETFs. ETFs are funds that trade on stock exchanges, much like individual stocks. They offer investors a way to buy a basket of securities in a single transaction. ETFs can track various assets, including stocks, bonds, commodities, or currencies, and can be both actively and passively managed. Here are some of the essential features of ETFs. Intraday trading. Unlike mutual funds, ETFs can be bought and sold throughout the trading day at market prices. Transparency. Most ETFs disclose their holdings daily. Tax efficiency. ETFs often generate fewer capital gains due to their structure and lower turnover. Lower minimum investments. Investors can often buy as few as one share. Are index funds better than stocks? Index funds and individual stocks serve different purposes and have distinct risk-return profiles. Index funds offer instant diversification by holding a basket of stocks, which can help reduce risk. They also provide a simple way to match market returns without the need for extensive research or stock-picking skills. For many investors, especially those who don't have the time or expertise to analyze individual companies, index funds can be a better choice. However, individual stocks can offer higher returns for investors willing to take on more risk and do thorough research. The bottom line. Both index mutual funds and ETFs can provide investors with broad, diversified exposure to the stock market, making them good long-term investments suitable for most investors. ETFs may be more accessible and easier to trade for retail investors because they trade like shares of stock on exchanges. They also tend to have lower fees and are more tax efficient. And that's it for today. If you liked the video, don't forget to smash the like button, subscribe, and turn on notifications